Welcome to the Real News Network. I'm Sharmini Pires coming to you from Baltimore. In London on Wednesday, 5 of the 6 stockbrokers in the LIBOR case accused of helping convicted interest rate manipulator Tom Hayes were acquitted by a jury. Tom Hayes was a former trader at UBS and Citigroup. The brokers acquitted worked at British financial firms ICAP, R.P. Martin, and Tullett Prebon Group, and they were accused of conspiring to manipulate the London interbank offered rate, also known as LIBOR. Now joining us to give us his take on the acquittals is James Henry. James is a leading economist, attorney, and investigative journalist. James served as chief economist at the international consultancy firm McKinsey Company. James, thank you so much for joining us today.
You're quite welcome.
James, why did the jury decide to acquit these traders?
They were charged with conspiracy to defraud, and apparently the jury just didn't believe that they subjectively had entered into an agreement with this UBS trader, Tom Hayes, who is now serving, I guess the latest figure is 11 years. He's one of the few people who's actually been convicted for this rigging scandal, which involves one of the most important benchmark interest rate settings that we have. It sets the price for up to $450 trillion of securities around the planet, and 9 banks have already paid about 12 banks have already paid about $9 billion in fines regarding this rigging. But in terms of sending people to jail for this behavior, we've only sent one to jail, and the securities fraud prosecution in the UK just failed miserably.
So, James, it seems to me that this kind of fixing has been going on for a long time. In fact, even the financial press is reporting that it has, partly because it is a self-regulated business, poor oversight. And in fact, LIBOR was administered at the time by the British Bankers Association and industry lobby group. This sounds a bit absurd. Is this what's still going on in the industry?
Well, there's a move afoot to transfer responsibility for setting this benchmark away from the banks on a sort of self-policing basis. Obviously, they haven't been doing a very good job. In this case, 16 banks would get together every day and basically agree on what the benchmark for LIBOR should be. And that opened the door to this kind of circle of friends where they were basically conniving to take positions on the benchmark that were favorable to their trading portfolios. But in this case, we had one guy who was at a bank, and all the other ones were at so-called interbank brokers. And they were able to say, look, we're not regulated, we're not banks. We were just leading this fellow astray. And by the way, the big players in this business, not only Tom Hayes, but as a senior trader at UBS and Citibank, but also all the other banks, UBS, HSBC, Deutsche Bank, some of the major Swiss banks, like Credit Suisse as well. Where is the penalty that makes it a corporate crime for the failure to prevent this kind of activity? It's awfully hard to prove these kind of individual conspiracies against traders. They can argue that they knew nothing or that they were just leading this fellow astray. And really, it was a systems crime. It was something that could not have been. There were 45,000 or more trades involved here from 2006 to 2010. Here we are 6 years later. Only one guy's gone to jail. The banks just take the fines and they pass along these fines to their customers or to the public at large. And there's not much behavior that's actually changed. So this is an example of the failure of the current regulatory system, where we rely on these kind of individual prosecutions, take a long time. And this one took 4 months to prosecute these 6 brokers, 5 of whom have been acquitted. and it took the jury one day to decide, you just didn't prove that these people intended to defraud.
Right. So if the problem was the charge, which was conspiring to fraud, and they weren't able to prove it, what's the solution here? How does it get regulated, and at what level, so that it can be prevented?
Well, I think one thing we could do would be to have a criminal statute that goes after banks as opposed to individual traders at banks. This is a fiction that these individual traders are themselves bad apples in great organizations. This is an institutional crime. The institutions involved should be held responsible, and there should be a corporate criminal statute that holds banks responsible for the failure to prevent this kind of activity. And that kind of legislation is being considered in both the US and the UK, but as yet has been held up by the banking lobby. So we have a string of these prosecutions to look forward to. They're hard cases to prove. The SFO in the UK is going after another case involving Barclays traders in February, and then another case after that. But stringing this out over time and not really putting responsibility on the institutions as opposed to these traders, lower level brokers in this case, is really a mistake.
All right, James, we'll follow them with you. I hope to have you back very soon.
Sure, good. Nice to be with you.
And thank you for joining us on the Real News Network.